Good morning. Welcome to our international speaker series. My name is Angela Zhang. I'm the director of the Philip K. Wong Center for Chinese Law. Today, I am very pleased to introduce Martin Chorzempa, who is a senior fellow from the Peterson Institute for International Economics. So Martin is one of the rare intellectuals that I know of who really understand China and the West really well. And he used to serve as a visiting scholar, as a loose scholar at Peking University's China Center for Economic Research. And he also worked for the China Finance 40 Forum in Beijing, which is a prestigious and well-known independent think tank in China. Martin graduated from the Harvard Kennedy School with a master in public administration, international development. He has a very large research portfolios. In addition to his research on fintech and digital currency, he also studies technology and national security issues like export controls and foreign investment screening. So his latest book, which is going to be the topic of today's talk, The Cashless Revolution, China's Reinvention of Money and the End of America's Domination of Finance and Technology. This book was just named one of the best economic book of the year by Financial Times. And I just finished it a few minutes ago, and I couldn't I cannot recommend it more highly to our audience. It's extremely well written, fascinating stories inside, and it is the book. Is a must-read book for anyone who's interested in China's fintech revolution. And I'm also extremely honored to introduce today's discussant, my own colleague, Professor Douglas Arner, who is the Kerry Holding Professor in Law, an RGC Senior Fellow, and Associate Dean at the Law School. So Doug is a leading scholar in financial and economic law, and is widely regarded as a leading thinker in fintech. And you probably have read his numerous books and articles in this area. And I really cannot think of a better person to join and comment on Martin's book today. And so without further ado, let me give the floor to Martin.
Thank you so much, Angela, for that very kind introduction. I'm going to share some slides here. And dive right into the book. So the book is The Cashless Revolution, and I'm going to try to, the book is actually a distillation of 10 years of work on fintech in China. I had the idea for the book all the way back in 2013, and it's been a long, fun process to write, and I'm going to try to condense that 10 years, which has already been put into 350 pages, then into a few minutes here that will hopefully you'll find interesting. So first, I want to tell you about why I wrote the book. The origins of this book are in my experience in China. When I moved to China in the middle of 2013, China looked like the top image. When people wanted to go to the bank or do any sort of financial transaction, they had to wait in line at the bank. It was a dusty, relatively inhospitable kind of bank branches. Very few people were using online banking, that kind of thing. There's a big problem with counterfeit money. So you can see the person on the bottom is running 100 renminbi bills through a counting machine. I often would have a taxi driver slip me a fake note in the evening when it was dark in my change. And because of that, the proliferation of counterfeit bills, even small corner restaurants would run small bills through these machines to detect counterfeits. Ultimately, China's system was pretty backward. It was heavily state dominated with financial repression. If you wanted to make investments, you had very limited options except for deposits where interest rates were set by the government. If you wanted credit, you often had to go, unless it was a mortgage, to some underground lender instead of the banks, because the banks preferred to lend to state-owned companies. So in short, I moved into a place that did not remotely look like the future of finance. But then when I left only 2 years later and came back to the United States, I felt like I was actually going back in time because China had leapfrogged. Instead of using plastic cards at any point, they went right to fully mobile digital payments. So you can see a picture here of the QR code scanning you're all familiar with, and then there's a screenshot of the Alipay app. And I'm sure many of you are already familiar with the ideas of super apps, but in the United States, it's not very common to have something like this, a single application that can make your payments, get you a loan, handle your investments, give you a credit score, handle your travel, book online shopping, social media, which you can do on WeChat, all of these things. It's an incredibly powerful business model. And when I came back to the United States to do graduate school, I had to start using paper checks to pay for things. Very few people took Apple Pay, so I had to carry my credit card around with me all the time. You scan that card, it's very insecure. At one point, my card details were stolen, and someone tried to charge a bunch of money to my card. And meanwhile, the fraud rates on Alipay are extremely low. So I really wanted to think, how did this incredible revolution happen in such a short period of time, especially one that was driven by private technology companies, where the previous version was very state dominated. So I think the reason it's a fascinating story, but it's even more important because of the insight into bigger, fascinating questions that we can ask about the world, about China, and about technology. One is the Chinese model the future of finance elsewhere in the world? Should we expect that super apps take off in many other countries, including potentially the United States? You can imagine a Facebook or Google super app. Why did China's government allow itself to be disrupted? Why has fintech been so much more successful in China than the US? I have a picture of Elon Musk here because he said that when he bought Twitter, he wanted to turn it into the everything app, which to anyone who's used WeChat is essentially WeChat. So for much of Silicon Valley, they look with envy on what the Chinese technology companies have wrought there, and they've done relatively little to change how finance is done in the United States. Then can authoritarian countries innovate? Clearly, the answer is yes. There was incredible innovation in fintech in China, despite the fact of it being an authoritarian government. And finally, what is the future of the dollar as China rises and money goes digital? There are many, especially in Washington, very concerned about whether China's digital currency leadership and leadership in fintech will lead to an erosion of the advantages that U.S. Financial institutions and the U.S. dollar have globally. I can only share a little bit of the fascinating story in this presentation, but it's a drama with 3 acts, and I want to introduce the characters right now. The first is the humble origins of fintech in China, when really it's just about, as I'll describe, some technology companies who found out that the financial system was really backwards and the banks weren't going to fix it, and they had to figure out how to do that themselves. The main characters here are 3 people. You have Jack Ma there on the far right, who has this incredible bombastic personality, very quotable, sometimes in ways which gets him in major trouble, as happened in 2020. But then he's obviously the founder of Alibaba and the one who launched Alipay, which became Ant Group, this massive fintech conglomerate in China that was valued at one point as high as MasterCard in the United States. And then on the complete end of the personality spectrum, you have Pony Ma. Although they have the same last name Ma, they are not related. Pony Ma is this quiet engineer type from Shenzhen, but who quietly created China's leading gaming, social media, and many more company, which is Tencent, running the WeChat super app. But then all this innovation is interesting, but none of it really would have been able to happen without the man on the top left, which is Governor Zhou Xiaochuan. He, for almost the entire period of fintech's beginning to the beginnings of a crackdown later, is the protector of fintech. He, in the already very early on in the 90s, discovers the power that the internet exists and is being used by finance outside of China. And he considers that finance is actually a technology. It's an IT industry. So he gains this obsession with integrating new technology into China's financial system, and has the idea that this is what's going to lead it into the future, not ordering the state-owned banks to do better. So we begin with humble origins, 2002 to 2012. Then from 2012 to 2017, innovation brings fascinating new financial freedoms to China and disrupts financial repression. But then from 2017 onward, you have the government appropriating elements that the private fintech companies had built and cracking down on it. And this definitely predates the Jack Ma speech, and we'll get into that. So the first lesson from digging into the fintech experience in this research was that payments matter a lot more than you think. And the reason I say this is that in the United States, we take payments for granted. We all have credit cards, not everyone, but most Americans have credit cards. And your experience doing digital commerce with credit cards is very easy. You just type in your credit card online, you can save it, and then with one click, you can buy things. That was not something that was possible in China, and it was a major roadblock to the growth of Chinese technology companies. So Pony Ma here has this quote on the early years of e-commerce, on digital commerce in China. He says, we had this amazing product, great subscription product for news and other things. But the thing is that it was 10 RMB a month, not very much money. Someone had to pay for it, and they couldn't just enter their card. They actually had to go all the way, walk to the post office or walk to the bank, take all this time out of their day and issue a money order for 10 renminbi every month. And no one was really willing to do that. So you see how the payment system, the fact that there was no system to pay easily online, made it really hard for Chinese technology companies to find a way to charge consumers for things. So that really held back the digital economy in the early years. But the response to it was to take these fascinating risks. So Chinese entrepreneurs had to take risks to invent what the US takes for granted. What I mean by that is, so in Tencent's case, they solved this problem by creating something called the Q coin in 2002, where you could go to Tencent, make one payment through the really clunky existing payment system and buy a bunch of Q coins. And once you had Q coins, you could then use them to buy services, but you could also eventually pay other people with Q coins. And Q coin is fascinating because it ended up becoming a completely parallel currency to the renminbi. It became this even though you couldn't redeem it for renminbi, you couldn't go to Tencent and say, give me renminbi back. You could only get digital services from Tencent. Tons of people just said, we have faith that someone else will accept Q coins if we charge them. And it became this complete parallel system with no license from the government. And they just let it happen for 7 years. Alipay solved a different problem. So that was solving a micropayments, a small payment problem. Alipay solved a different problem, which is when e-commerce began in China, there were, without a credit card, you don't have protections. In the United States, if you buy something online and it never arrives, you can call your bank up and you get your money back right away. That is not true in China. So Alipay solved this trust issue where also, if you are selling something online, you don't want to send the goods until you're sure that somebody has paid for them. So Alipay stood as a trusted counterparty in the middle that said, I will guarantee you, merchant, that the person who is ordering this has paid, and you guarantee the person who bought the item that if it doesn't arrive or it's a faulty or a counterfeit good, we'll give you your money back. And from there, it ended up being built into a payment system. But really, the beginnings are just about allowing digital commerce to thrive. Without these innovations, which ended up becoming huge super apps, you would not have had this. The government played a really interesting role here. It was hands-off. So I often liken the early period of fintech in China to a libertarian paradise in an authoritarian country, because there's a pattern here. You have 7 years between innovation and regulations. So Alipay is put out around 2004. It's not until 2010 that you have licensing, that you have actual regulations. And then I think 2011 is when the first licenses began to be granted. There's a really long time to be able to run a payment system, which is massive, without any official government rules about what you can and can't do. And the PBOC in 2005 made an explicit decision. They said, this is a period of innovation. And so from a legal perspective, I know many of you are focused on law. This is a really interesting example. They kind of suspend rule of law. They say, we don't know what the rules should be for these new fields. We're going to watch how it develops and then develop a legal framework later. That's the kind of thing that would not fly remotely in a country like the United States. So it's an unregulated gray zone, and there is some risk. So Jack Ma has to tell, his telling of the story is very dramatic. He says he was at the Davos and his team called and said, we're ready to launch Alipay, but we're nervous because the government hasn't told us we can do it. There's no way to ask the government for permission. And he says, if someone has to go to prison for it, I'll go. It takes this very dramatic, risky step. Of course, he knows that it's something that's encouraged. So as long as you're on the right side of the political line, even if it's not strictly legal, it's okay. At least that was the historical experience with it. Another element of the rise of Chinese fintech that's crucial is really the role of foreigners in terms of foreign ideas, capital, and competition. And that's a really important one when we think about the off-sided argument that China has successful internet companies because they blocked foreign internet companies, so they didn't have the competition that snuffed them out. I don't buy that argument, and I'll tell you why. So first, the capital for tech titans like Alibaba and Tencent did not come from subsidies and government plans. It came from investors in Hong Kong, came from companies like Goldman Sachs, came from companies in South Africa, and it came largely from SoftBank and Yahoo, which gave Alibaba money they used to beat eBay in the Chinese market. This capital, the fact that this company was really interesting and had a positive future was something recognized by foreign investors, not so much by Chinese government, although the relationship became closer later on. And then these built on ideas from abroad. So eBay had already tried the escrow kind of system that Alipay used. Alipay looked at what PayPal had done, and the QR codes that they use for payments now were actually developed by a Toyota subsidiary in Japan for testing. And actually, the first example I can find of using QR codes for payments is not in China, it's Starbucks. I can't find any example anywhere else that is earlier. So they're able to learn from how this technology is applied elsewhere and then apply it in a new way. It's a kind of business model innovation. And what I find in the fintech space is in areas that were protected, so credit card payments and debit card payments were given an explicit monopoly by the Chinese government to UnionPay, a state-owned company owned by the state-owned banks. And in that area, they essentially locked out Visa, MasterCard, foreign competition. How well did that area develop? Well, it was backward. Not that many people used credit cards. So that protectionism did not help them. But in areas that were competitive, like e-commerce, you see that actually the threat of foreign competition is crucial to driving this innovation. The reason that Alibaba launched Alipay is that they had entered consumer-to-consumer e-commerce a few years earlier. Why did they enter consumer-to-consumer e-commerce? It's because eBay entered the Chinese market, bought EachNet, which was then the Chinese leader in auctions, and Alibaba, Jack Ma, was afraid that this foreign company was going to eat their lunch. Without this, they would not have even gone into these markets for longer. And the threat of entry of PayPal is something which led them to want to create Alipay. So you can see that actually foreign competition played a much more positive role in the development of Chinese fintech than any sort of protectionism. Then we get up to 2012, and this is when the story reaches a crucial turning point. Fintech at this point is only really enabling online commerce. People are buying things online with fintech, but they're not really getting credit. They're not making investments, and they're not buying things in person using fintech tools. And because of the financial repression that artificially lowered interest rates and constrained credit and investment, there's this artificial undersupply of credit and investment. So if somebody's able to enter that market, gets the political permission to do so, they have this huge unaddressed market that they could begin to serve. And smartphones are just beginning to become widespread enough, including with mobile payment, to allow digital payments to happen anywhere. If you don't have a mobile phone that has the ability to do things like scan a QR code, you can have a great fintech tool, but if it has to be accessed on a desktop computer, no one can buy a good in real life, call a taxi with it. Then the party invites technology companies to break up the state monopoly. This is the most important moment in the whole narrative. And Wen Jiabao, at the end of his term as premier, says we need to break up the bank's monopoly. And why did they do that? Well, growth is slowing in China in 2012, slowing actually quite sharply. They had this binge of credit as stimulus after the global financial crisis. So debt numbers rocketed up and their growth began to slow down. And they recognized that they needed a different financial system to support the changes in China's growth model that would be needed. More, more small, medium enterprises, more focus on innovation rather than big infrastructure projects. And the big state banks just were not well placed to fund that kind of small, innovative activity. So they invite private capital into the financial field and license tech firms to provide banking, insurance, credit investment, just about everything else. And for the first time, there's real competition with the state-owned banks. then this is the opening which creates the possibility to launch a product like Yuobao, which is the single most important product in beginning to show that fintech could actually compete with existing financial institutions instead of just being something that's small on the side that they don't have to worry about. This is a money market fund that Jack Ma launches in 2013, actually almost the exact same time that I moved to China. And they found a loophole, which was deposit rates were capped by the government. If you were doing a demand deposit, you could pull out at any time. You put that in the bank, they'll give you 0.35%. But when banks were lending to each other, they were lending at 6%. And Jack Ma said, why don't we create a money market fund, which simply goes into this market where the banks lend to each other at market rates, and we pass that on to consumers. And within a very short period of time, hundreds of billions of renminbi leaves the banks at possibly the worst time for them, and goes into Jack Ma's money market fund. And really, what's so important in this moment, that in many countries, the banks would have been able to quash this innovation. They would have said, this is unacceptable, it's raising funding costs for the banks. But instead, what happened is, all throughout state media, and including a special role for Zhou Xiaochuan, they said, we support challengers. We recognize that there needs to be competition or the financial system is not going to shape up. So they failed to shut it down, and instead they had to compete. And as a result, even people who didn't put money in Yuobao but just had their money in the banks suddenly were making huge, I'd say estimates are in the trillions of extra renminbi in returns, because everybody raised their interest rates to Chinese savers. It was a huge transfer of wealth from Chinese banks to Chinese savers at this time. And this unleashes a fintech boom. It starts with the Yuobao, but then moves into offline payments, and they start their own banks and asset management companies and much more. And China very quickly reaches the global frontier of fintech adoption. This is just one chart here on the right showing you that China and India are near the top. The US is much, much lower. And the reason for this is competition. It's that suddenly companies that were previously in somewhat orthogonal markets, Ali dominated e-commerce, and Tencent dominated gaming and social media. They didn't really compete so much directly with each other. But now, once you have this super app idea, then every single product that you have competes with every product in the other, and you want your whole bundle of products has to compete with the other. So the tech companies massively subsidized the move to QR code payments. I was in Beijing at this time, and you could pretty much get a free taxi ride if you scanned a QR code to pay for it, because Tencent and Alibaba were throwing so much money at this problem. And this, market-driven subsidization is what caused this rapid digitization of payments that the 10 years of state monopoly could not achieve. But it happened in 2 years because of technology firms. And, I know you're not in the United States, but I say, why there, not here? Why in China, not the US? One reason for it is that the improvements that technology companies could make in China were much larger over what existed than in the United States. That made it worth the risk for the party. Some of these things might blow up, and worth the try for consumers because it was just so much better than what they had. Whereas in the US, you keep scanning your card, it's not that inconvenient. And they added a non-financial bundle to an existing bundle of services. So it became this one-stop shop for all sorts of services. And the US took the opposite approach. It was like all these tiny fintech startups that were going to do one little bit. The picture here is supposed to look like a mess. It is the Wells Fargo, the major US banks homepage. And it's a logo of all the different small fintech companies that were trying to compete with each of the individual services on that website. And what you see is, if you want to have the same experience of one bank account that's easy to manage, you have to download dozens of small fintech apps that all have your information. They might lose it. They might lose your money. That's pretty worrying. So it was a much worse experience in the US than it was in China. And they also made a smart technology choice. And this is also learning from the past. Google Wallet was not very successful. Apple Pay took a long time to come up. One reason for that is they used NFC, which is, you put your phone next to something and it can kind of feel, it sends the payment information. But there was this battle between who would control the secure element in the phone, which passes your payment information. The phone company wanted it. Apple didn't allow anyone except Apple to access that on the iPhone. And it was just this mess of competing interests. Whereas Alibaba looked at that, Alipay looked at that, and they did everything but NFC in Alipay. because any app on your phone can operate the camera and they can display something on the screen. And that was all that was needed to use QR code payments. And whereas in the US, you had to get new expensive software and hardware to read NFC. In China, anyone with a smartphone could start accepting payments. That made it really easy to take off. It was not all just a success. There are many hard-earned lessons from China's fintech experience where there are costs. The one reason for that is it's really hard to tell ex ante what is true innovation. And in finance, if an innovation fails, many more people lose out. If venture capitalists and startup employees, lose some money because a startup failed, they kind of knew what they were getting into. But generally, investing in financial products, you want there to be good consumer protection. And this image here is in Beijing. It's around 2015, and it's just buses as far as the eye can see with windows taped shut. And it's to cart off protesters who are protesting losing their money in peer-to-peer lending scams. The government does not want major issues to social stability. So there are failed ideas like peer-to-peer lending, which led to hundreds of billions of renminbi in lost money for savers. Many people who had invested in these schemes lost their savings. Some committed suicide. It was a really horrific result, but it was part of the cost of having a really open, positive environment for innovation. That doesn't come for free. China was able to put a genie back in the bottle and maintain financial and social stability despite these challenges, but it's not the kind of action that many democracies would be able to do, that kind of quelling of protests. So that's something where we want to be careful about the lessons we take from the Chinese experience. And I think the rest of the world can learn a lot from this experience. You can avoid the areas where China has experimented and not done well, and you can learn from the areas where they did really well, which is actually a lot. And international expansion is another interesting topic. So, if this were just about China, it would have maybe limited resonance around the world. But, the question is, are these going to take over in the rest of the world? And what I've found is actually they've had surprisingly little success outside of acceptance and inspiration. So I gave Elon Musk earlier. The top is Mark Zuckerberg and his head of digital currency for a while. And they were clearly inspired by what WeChat was able to achieve in China, and they wanted to do it globally through the Facebook Libra idea. And Elon Musk has the idea, PayPal wants to be a super app. So all of the companies, many of the companies, most important firms in Silicon Valley, look with envy and want to try and emulate elements of the Chinese model. And in dozens of countries around the world, including at local drugstores around me in Washington, D.C., and in places like convenience stores in Thailand, you can use Alipay or WeChat Pay to pay, but that's really only designed to cater to Chinese tourists. It's not users abroad. So I kind of call it, you're still serving the domestic market, but just when they're abroad. Instead, what happened is in areas where WeChat has tried to compete, they have lost to WhatsApp, which is owned by Facebook, in countries like India and Brazil and others. And without the foothold of a strong social media presence, they really aren't able to build a super app. They need some strong element to anchor the bundle of services they provide. And so the super app model, at least practiced by Chinese companies, hasn't really taken off outside of China, maybe Hong Kong and somewhat in Singapore. But I think in Singapore, it's more local Singaporean companies who have been more successful. Now, the main thing people are interested in Washington is the dollar doomed by China's move to create a central bank digital currency. I actually think it exemplifies the shift away from private sector-led innovation, where everything I've described to you up until now has really been driven by private companies competing with each other. And instead, it's been a shift to innovation that's coming, financial innovation from the public sector. And the historical track record of the public sector trying to create these innovations through UnionPay, for example, is not very good. So it's unclear whether they'll be able to stay innovative if they try to have the state be the basis for it. The central bank in China, the People's Bank of China, is the most advanced in central bank digital currency pilots of any major economy. And virtually every major economy is currently exploring whether they should issue a digital currency. But it's not clear to me that there's a real first mover advantage. Actually, just like we saw with Google Wallet and others, being the first mover might actually be to a disadvantage. It might commit you to a technology path that's not ideal. And if you make a mistake in your digital currency, you could undermine the entire foundation of financial and monetary stability. And so I think that's a reason that although many, many years ago, the PBOC committed to launching a digital currency, it still remains in the pilot stages because they're very cautious about unleashing it because it could have very problematic consequences if you have a cyber event, for example. I see many nascent threats to US dollar dominance, but they're not mostly about technology. It's about the fact that payments are still very expensive. A lot of that's due to regulatory means, and the only way to get around those is often illegal arbitrage through things like stable coins that aren't clearly don't look these days like the future of finance necessarily. And another reason that China is so much more advanced than the US is that it's less concerned about privacy and an increase in the state role in retail payments than the United States. So any central bank digital currency would have a much higher privacy bar in the US or Europe or somewhere else. So ultimately, I really don't see it as a short-term threat to the USD, even though I think that the renminbi will eventually play a bigger role. The government's vision for the future is something that's very different than the way things have developed so far. The first is the state digital currency is the base layer for innovation. That's where the smart contracts, in blockchain parlance, will be drawn up. And they want the monopolistic duopoly of Alipay and WeChat Pay to open up what they call the walled gardens to innovative startups. So all the data that's created this incredible flywheel of all these services feeding data to each other within one closed ecosystem. They want that data to be accessible to other innovative companies. They want the super apps to unbundle. They start to think that even though it was the root of the fintech success, they now see it as, if you dominate payments, then you dominate all the rest of financial services. That creates conflicts of interest. You get too big, you could be risky. And then they also want to create much more consumer choice for data protection. China now actually in many cases has much better data protection laws than the US. Of course, there are carve-outs for the government, but at least vis-a-vis private companies, now there are many more requirements on allowing consumers to choose how their data is shared, including across services in one company. There's less tolerance for financial risk. They don't want the push for consumer credit, which underlied a lot of the fintech expansion, especially the evaluation of Ant Group. And they want tech firms to serve state development goals. The way to put it is they want breakthroughs in semiconductors. They don't want 1 minute faster latte delivery to your office through pushing the delivery worker harder. I'm near the end, but fintech and COVID really show the power and peril of these systems. Fintech was key to the successful COVID response in China initially, where they had the whole country locked down and they had to figure out who is safe, who can leave. So who do they turn to? Not the government, but Alibaba. Hangzhou's government turns to Alibaba and says, please help us develop the algorithm that will determine who can go out and get groceries, who can go back to work, and who's at risk. And that created this health code system. But then that health code system became also key to the disastrous continuation of that COVID policy, which hit China's economy so much last year. We also see that being fully cashless leaves many behind. So many people who are elderly, let's say, did not have these apps, so they couldn't generate these QR codes and they weren't allowed to go anywhere. So they had to scramble to come up with some paper-based way to have these codes. You can't just assume that everybody can use these digital tools. And there were elements within these apps which also allowed the police to track where everybody was at any given moment. If you entered a public transit station, if you went to a bar or restaurant, they knew exactly where you were for contact tracing, of course, but that data might be accessible beyond. And then another is there's some really sad stories in the book about how if WeChat has not just your whole financial life but also your whole social life, will you risk writing sensitive speech on that app knowing you might get locked out of something that is so crucial? And actually now in some cases cyber criminals are, instead of being put in jail, they're banned from using WeChat and Alipay, because it's this horrific punishment that you can't live without these things anymore. So I worry about the self-censorship that could be involved if in other countries, if your speech and your finances are all bundled together in one thing that you can be shut out of if you say the wrong thing. So to conclude, China's cashless revolution has offered great promise. It's revolutionized lives in China and enabled this incredible growth of digital ecosystems that have massively improved life for hundreds of millions of people. But there's also great danger to civil liberties, privacy, and also monopoly with when one firm can control so much data on a single individual. The US has many advantages still over China, despite its, especially the US dollar, despite the advances in technology in China, but it cannot afford complacency. I think the countries like the US and others will find a balance between a very centralized Chinese system and a very decentralized Web3 kind of ideal, which ends up being too anarchic to actually work for an economy. And I'll conclude by saying China is the pioneer in fintech and its regulation. And there's a lot the rest of the world can learn from its mistakes and victories, and a lot more detail is in the book. So thank you so much for having me, and I hope you enjoyed the presentation.
Thank you so much, Martin. That was fascinating, and you tell the story in such a lucid and concise way, and I really appreciate that. And now I will give the floor to my colleague Doug, who will give some comments on the book.
Thanks, Angela, and thanks very much for that, Martin, and congratulations on the book, and really enjoyed the presentation as well. I'm going to kind of, I think, pick up on a few of the points that you made, and it's really around, I think, some of the broader lessons that we can draw from the Chinese experience. And I'm really going to focus in on, I think, 4 of those, make that 5: payments, data, regulation, scale, and cross-border monetary issues. And one of your comments in there, I think, was tremendous, and that is that payments matter. And this is something that, from my team's research and sort of looking at different aspects of digital technology, of digital finance, and looking at their impact across not just economic growth, but across all of the 17 UN Sustainable Development Goals, the thing that we find has the biggest positive impact across the greatest number of positive sustainability indicators is the ability to make and receive payments. So in other words, this idea of digital payments is tremendously powerful. And I think if we look at China's experience from a standpoint of financial inclusion over, say, the decade from 2008 up to 2018, China was the single biggest contributor to increases in financial inclusion in the context of having access to digital payments and financial services globally, to the tune of something like 600 million people gaining access to financial services for the very first time. And this is something that, if you think about the digital transformation of China's financial system and economy, we've never seen anything of this speed and this scale previously. Now, India, more recently, has done something similar sorts of numbers, but from a later period. And I think if we look at both of those experiences, one of the key linkages actually has to do with identity. If we look at China, the key method has been through the smartphone, through the mobile phone, and linking a smartphone number to a government identification document as a means of addressing those identity issues. In the context of India, lacking widespread access to a formal government document, they've instead created a system of biometric identification, which has then empowered access to accounts and finance. And I think when we look at other countries around the world that are looking at the single biggest thing they can do from the standpoint of transforming their own economies and societies, it's digital payment. And this is something where, yes, we now have literally dozens of countries working on CBDCs, central bank digital currencies. But as I think you've rightly highlighted, the real impact is not coming from the central bank digital currencies. It's coming from digitization of payments. Whether we look at Alipay, WeChat Pay in China, whether we look at UPI in India, we look at PIX in Brazil, we look at an increasing range of examples. And I think this is really a key point when we think about it going forward, is how do we bring together the digital infrastructure, the identity systems, which can support this widespread access to payments. Now, it's interesting, if we think about the genesis of what was originally called DCEP, the Digital Currency Electronic Payment System, now usually called the ECNY. And of course, part of this comes from central banks have always had a focus on the role of technology in monetary and payment systems. But if we look at the particular genesis here, we can say concerns about systemic risk and over-reliance on the private sector. And we certainly haven't seen the ECNY be a replacement, but it is a backup, and I think that's important. Second, inclusion. We often say 1.1 billion people have access to Alipay or WeChat Pay, but the population is 1.4. So that gives us a couple of 100 million people that don't actually have access to the commercial payment systems. And this means that there is a role from the standpoint of trying to reach that non-commercially viable last mile. And this is a huge challenge for countries around the world. The other group that pre-COVID was very much excluded were foreigners. And certainly one of the aspects of the ECNY was a mechanism to easily give access to people who didn't have a Chinese mobile phone number to the electronic payment system. And that, I think, is a very important idea. Interoperability. As we get to one of these other points, scale, one of the key aspects of the Chinese experience was two largely non-interoperable walled garden systems, and lots of years of battling about breaking down that. And you see a combination of both political regulatory changes as well as introducing electronic rail that effectively ends that interoperability barrier, which is huge from the standpoint of access to payments. And finally, the international point, which I'll come back to. Second point is really around data. You know, if we think about one of the biggest impacts of Ant or Tencent beyond payments, it's been in the context of SME access to credit. You know, if we think about grand development challenges, access to finance by small and medium-sized enterprises everywhere in the world, which drive employment, which drive growth, which drive innovation, is always a problem. And we've tried lots and lots of different solutions to this over decades. And I think a very important aspect of both the Ant and the Tencent WeBank experience has been the use of large-scale big data models, integrating data from across ecosystems, from payments and a variety of other channels to do automated cash flow based and reputational analysis of small and medium-sized enterprises to provide micro and actually scale credit as well. And this, from this grand challenge standpoint, is a huge contribution of the Chinese experience really to others. And this really brings us to the third point, which is around data. And one of the key experiences, if we think about the ecosystem model, the super app approach, has been the key importance of data. And if we think about the regulatory responses since 2020, much of those have been about trying to figure out a way to balance how do you maximize the value of aggregate data from the standpoint of a society while minimizing the risk of dominance and control of that data by single private companies. And this is a grand challenge that China has faced first, but the US, Europe, India, countries all over the world are very much struggling with how to balance the benefits of data with, particularly in finance, the combination of economies of scope and scale with network effects, which lead to a natural, if not oligopoly, in some cases duopoly, or even monopoly, with many of the benefits aggregated to the private provider. And the final point really is about regulation. And I think, as you've highlighted, if we look at this initial period, and I would really rate it from up to 2015, 2016, when in 2015, we see a lot of market turmoil in both currency markets as well as in financial markets. And we see a response beginning in 2016 to build a regulatory framework, first for digital finance, which largely closes down the thousands and thousands of small P2P and other operators, but allows ever greater concentration in the dominant platforms. We then see from 2020 a response to try to build a more comprehensive approach, reflected most recently in our creation of sort of super ministries for data, finance, and technology to highlight these three areas and their central importance. And I think when we look at the Chinese experience, we have to say, as you highlighted very much, that a permissive approach can have lots of benefits. But there is this natural tendency towards concentration and dominance, which raises its own issues and risks. And this is a balance that we're seeing an increasing number of countries trying to come to terms with. Thanks very much. Great presentation, great book.
Thank you, Douglas. I agree with a lot of things that you said about the difficult balance that China and regulators need to strike in terms of maintaining growth while also managing potential financial risks with all this big innovations. Now we have a question from an audience, Randall, asking if Martin or Douglas, feel free to chime in, if there's more insights you could share on China's vision and stance on the central bank digital currency, for instance, the preference on the balance of national security and seeking greater international influence. And as Martin mentioned, and also it's one of the focus of his research these days, China is doing a lot in trying to reduce its reliance on the US dollars, but for a long time it hasn't been very successful. And query whether that will, come to any, go anywhere in the near future. So Martin, do you have any thoughts on this?
I do. The first thing you have to recognize is that there are two kinds of central bank digital currency that don't really relate to each other that much. One is retail central bank digital currency. That's like if somebody uses the ECNY wallet to buy a Jianbing on the corner in the morning. And the other is wholesale central bank digital currency, where you're talking about big financial institutions and maybe corporates, but that's not that likely, honestly, because of how disruptive it would be, the really big movements of money. And so the way I put it is the US Treasury and US financial institutions really do not care whatsoever whether someone is buying their coffee in the morning in Beijing or Shanghai with a CBDC instead of an Alipay or WeChat wallet, or even if they're using CBDC in that doesn't really matter whatsoever. That is a purely domestic affair, in my view, of course, because also there is a question about international use. But the likelihood that with capital controls and all this, the Chinese government allows people to just spend ECNY abroad freely is an open question. And whether, say, a foreigner that goes to China and gets ECNY, whether they will be able to take that money back home with them in the same way they could with cash, would they be able to keep the money in that wallet? Would they be able to transact it? That's not really clear, but I suspect it's not going to be very freely usable. So then we look at the wholesale side, and it's really interesting because the PBOC is involved in multiple projects, some with Hong Kong, one called the BIS Multiple CBDC Bridge Project, where they're looking at a way to directly connect currencies with each other instead of going through the US dollar. So what a lot of people don't realize is that, for example, when when Korea and China trade with each other. Something like 95% maybe of that money, of that trade, goes to the US dollar. And you're like, why don't they just trade Korean won for renminbi? Well, the answer is there aren't that many people who want to trade Korean won for renminbi, but there are a ton of people who want to trade Korean won for dollars and renminbi for dollars. So those markets are super liquid. The fees to trade on those markets are really low. So let's say it costs you 3% to transfer USD to, Korean won to renminbi. It might be 1% to do US dollar, and then 1% again to go from US dollar to the renminbi. So that's USD. Then in addition, if you want to hedge the risk, so you're a Korean firm, you have costs in won, and you want to make sure you don't have a risk that the renminbi moves on you, between the time that you've incurred those costs and you actually get payment for what you're exporting to China. Those hedging instruments that allow you to fix that rate today are really cheap and easy to find for US dollars and pretty hard to find for renminbi. So when I think about it, I think these little things like mBridge are exciting. It's interesting, but I think about it just like Doug was talking about, a backup for, CBDC as a backup to Alipay and WeChat Pay. It's important for China and other countries to have a backup system they can use to keep commerce moving in the event of they're locked out of US dollars, in the event of sanctions, something like that. But unless it's going to have to be a major undertaking if it's going to have all of the advantages going for it that the US dollar does. So I think these are promising in the long term, but they don't really spell an end to the US dollar just because the mechanics of what gives the dollar its advantages it's like a hub where everybody's connected to the US dollar. And it would take some major titanic event for that to shift. One possibility would be massive sanctions on China in the event of, say, an invasion of mainland invasion of Taiwan. If the US put major sanctions on, that could lead to much more of a recognition that if you want to deal with China, you can't use the US dollar. But barring that, I don't see it being much of an impact.
All right, interesting. A lot has happened since the book was published, given the fluid nature of China's fintech regulations. And now Ant has been restructured, and there's a lot of speculation that Ant will soon become a financial holding company and will get the license. And I recently visited Ant actually just earlier this month, and business seems to go on as usual, but you can still feel the regulatory scars there, the concern about the uncertainty of Chinese regulations and the unpredictability nature of the government's policy, and then after the two recessions, and China is now creating trying to consolidate the regulatory power of the financial regulators, and China is also creating a new data bureau in charge of overseeing all these data resources and trying to push more innovation out of its data resources. I wonder, Martin, given all these fluid developments, you probably have been closely watching all these things. What do you make of it? What do you think, given what's happening on the ground in China right now, are you still optimistic about China's fintech revolution, or are you a bit more cautious these days?
Yeah, so I think that the clouds of uncertainty are mostly going away at this point, because Guo Shiqing recently said, for example, that the 基本上完成, so he said it's fundamentally the rectification of platform companies' financial subsidiaries is largely finished. And actually, as you said, business largely goes on as usual at this point. The apps have not been split apart as violently as they easily could have. They still function to a large extent the way they have. And I think that's because the authorities recognize that they have something really valuable in the way that these apps have functioned. And although, Ant's valuation is much lower now because it can't continue to massively expand consumer lending, it's kind of consolidated its position. And I think Doug made the right point, referring to the same point again, though he made so many good points. I agree with all of them. That that the ECNY is designed to be a backup in many ways, and is not necessarily going to, completely displace Alipay and WeChat Pay going forward. I think that they're going to consolidate the gains that they've had, but the era of disruptive innovation is over. And the way I describe it is, it's not like a wave of regulation has crashed over them and now receded. It's like it's a tsunami has come, swept over them, but then left a permanent rise in sea level out afterwards. The level of regulation is much higher. You mentioned the financial holding company regime. There's now supervision over the entire, in a way that previously they could kind of play off different regulators, because the regulators could only see different pieces of the business. They didn't see the whole thing. And that's why we have the anti-IPO debacle. I call it a debacle because, they canceled it right before, which made it look like it was just some retaliation for Jack Ma's speech. But actually, the way I view it is there were a lot of really risky and problematic actions that were taken that were inherent in Ant's business model that weren't really fully understood by the regulators, including, most importantly, the fact that 98% of the funding for their loans was not from them. It was all the risk of their lending portfolio was offloaded to financial institutions. And that information didn't come out until the second round of their IPO prospectus. And it takes time, as you know, for things to filter up through the Chinese government bureaucracy. And the speech just really raised the urgency. If he hadn't made that speech, they probably would have done the IPO. And then they still would have figured out that these problems existed. And then they would have had to have a much worse action where they would have had an IPO'd company where tons of retail investors had invested. And then their action, because they couldn't get their acts together and figure out how to regulate it before they allowed it to IPO, they then crashed the stock directly. And of course, they've done that with other things. So, they're not unwilling to do so, but it would have been much more embarrassing than what happened. But they still recognize that there's some value. And I think it's going to continue to be important, and they'll continue to look abroad.
Right. Yeah, I do remember the fascinating details that you told about in the book about Jack Ma's speech, that he's going to throw the bond. I think somebody told, is it your old boss said that he's going to throw the bond, but Jack said, I'm not going to throw a bond, but he did to throw a bond. And I came left with thinking about the counterfactual that had he not made the speech, the Chinese fintech regulation, as well as the whole platform regulation, would probably come away very, very differently. The whole story will have to be rewritten. And so I 100% agree with your observation in the book. Look, Martin and Doug, thank you so much for coming and participating in our series. And again, I highly recommend this book. I personally, I've been closely following this area, but I still not a ton reading Martin's book. He has real insight, not just insights, but also a lot of close access to a lot of the information sources. And I'm sure anyone who's interested in this area should take a look at this book. It's a must read for everyone. So I want to congratulate Martin for the success that you have achieved of this book, and it's hugely popular as well. And thank you all for coming, and safe flight to Martin. He's going to Italy tomorrow. And thank our audience for coming, and I'll see you guys next time.